In this video, I'm going to be talking about the hidden fees when you buy any property in Malaysia. Now, this is part 3. So if you haven't checked part 1 and part 2, I highly recommend you watch them because it's a very important information that most people are unaware of. Now, for this video, I'm going to be showing you other smaller fees and something that you need to pay to save you from losing a lot of money when you buy properties. Alright, so first, congrats on getting your own property. You've already got the keys. And now what happens next? What are you going to have to pay for when you've already acquired the property? First, let's talk about the deposits. Okay, these are standard and also compulsory. You're going to have to pay a deposit for the electricity, water, and if you want an internet connection, you're going to have to pay a broadband fiber subscription. This one depends because sometimes they require a deposit, sometimes they need you to pay upfront. You're gonna have to check with your local, you're gonna have to check with TM if you want to subscribe for Unify, Max is 1, or Time. Time is usually used for high-rise condos. And also if you want a telephone line, but nowadays everyone has a smartphone. I don't really think a telephone line for the house is necessary, but if you want to, then well, you're gonna have to subscribe for the subscription. Now, for strata title properties, which are basically high-rise condos or landed properties which are in a gated and guarded community, these developments, you're gonna have to pay a maintenance fee, right? And also a sinking fund. So usually the management of the developer will ask you to pay for several months deposit. So maybe it will be 3 months or even more, maybe up to 6 months deposit upfront they have to pay. Now, second, let's talk about taxes. Now, there are 2 types of taxes: cukai tanah, which are called quit rent, and also cukai pintu, which are called assessment taxes. So for the first one, cukai tanah is paid to the state government. So for example, if you're living in Selangor, the Selangor state government; if you're staying in Pahang, Pahang state government, and so on and so forth. Second, the cukai pintu. Okay, this one is paid to the local council, like the DBKL, MBPJ. You're paying this to cover the surrounding house maintenance around your house, like the roads in front of you. When you throw your trash in the garbage bins in front of your house, okay, the workers that pick up the trash and everything, they can do this because we pay for the assessment tax. So please pay your taxes. It's for your own benefit. You're not just simply burning your money away. And also it's also for the cleaners that clean the roads, that sapu the floors and everything, landscapes around our area. And for strata title properties, like I said, high-rise condos and gated and guarded communities, usually this is what the developer will do. The developer will one shot pay the cukai pintu collectively together because there are several units in one condominium building. So it will be quite a hassle for everyone to pay one by one. So the developer will actually include this into the maintenance fee. So for a particular month, maybe I think early in the year, you will see a sudden spike in the maintenance fee. So that's why, because you're paying for the cukai pintu. Alright, so what if something bad or unexpected happens to you, the buyer, or the property? These 3 things could happen. And these are things that we can't necessarily control. Unexpected death, TPD, which stands for Total Permanent Disability. And also what happens if your house gets burnt to the ground. Now this is where insurance comes in. So please pay your insurance because we don't know what might happen. Bad things can happen to anyone at any time. So for the first type is what we call the mortgage insurance. Alright, so there are 2 types. Now I don't want to confuse you with this. It's actually quite simple. So I'll try and explain it as simple as possible. There's first what we call the MRTA and also the MLTA. So one is MR, one is ML. Now for conventional loans, it ends with an A. For Islamic loans, it will end with a T. So MRTT and MLTT. So you only need to pick one of these four types. You don't have to pay for all four of them. And then paid on top of your bank loan up to 5% of the price of the property. So for example, you buy a property that costs 100,000. So banks can offer a financing of up to 90%, right? 90K. So there's actually another additional 5% on top of it that the banks can include this MRTA or MLTA to finance on top of your loan. So there's a difference. For MR, TA or TT will cover the outstanding loan that's left. For ML, TA or TT, it will cover the full amount regardless of how much you've already paid up to the banks. So I'll give you an example. Let's say you buy a property that's priced at 500,000. So you already got a 90% LTV from the bank, which equals to 450K loan coverage. Now, after 10 years, let's say the outstanding loan left is 300,000, and then one of these two things happen, either an unexpected death or TPD. So if you buy an MR or an ML, how much will you approximately get? Now these are just estimations, they're not exact figures because there's other hidden fees involved as well. For MR, TA or TT, you'll get 300,000, which is the outstanding loan amount left. For ML, TA or TT, you'll get the full 450K. But ML, TA or TT actually costs more than MR, TA or TT. So there's pros and cons on each side. And another thing about this, if you're buying a property and you're investing, let's say you're only planning to hold it for 5 years or 7 years, you don't have to pay for 30 years MRT, MR or MLTA insurance. Just pay for about 5 years or 6 years, depending on how long you plan on holding the property before you sell it. And it will cost way lesser. Now, the second type of insurance is a fire insurance. So what happens if your house burns down to the ground? Now, the MRTA and MLTA won't cover this, but the fire insurance will. But it will only cover approximately 80% of the house value, and also depends on the insurance company. Different insurance companies, they have their different policies. So here's how it works. The banks work with other third-party insurance companies outside to help you pay for the fire insurance so that you're covered in case something bad like this happens. And this one is paid once a year, so annually. And there will be 1 month, I think maybe around the first quarter or second quarter, that's about March or April, I'm not sure. It also depends on the insurance company's policies. You will see a sudden hike or increase in payment for your installment. So normally, let's say you pay only 2,000 and then you see, oh, it's 2,500 for example. That's why, because you're covering the fire insurance. Again, this isn't a nuisance because bad things can happen anytime. You don't know. Maybe your neighbor cooked something and they left the gas stove open, their house burned, and you also get affected. So it's best to get insurance, these two insurance, mortgage insurance, which is you're going to pay together with your loan installment. Fire insurance, well, also with the loan installment, but fire insurance only once a year. And mortgage insurance is going to be determined when you buy the property. When you sign the SPA, the letter offer, when you get the loan from the banks. All right. Sorry if the explanation was a bit wild. I try to explain as much as I can, as simple as I can, and I hope that you can understand everything that I just said. If you have any comments or questions, just drop them down in the comment section below. Please subscribe and like this video. Share them to your friends if you think that this topic can actually help them with this. And again, thanks for your time, and I hope that you have a nice day.